Welcome, everyone. Thank you for joining our webinar. Lots of great information today. We'll take a moment to allow people to sign in, whether you're on Facebook, whether on YouTube. Please log in. We'd love to hear from you throughout the event. And we have lots to cover tonight. Why don't we just start going through some of the introductory details here as folks log in. And Kevin, I have to do this every time. We have to make the lawyers happy.
Yes, you do.
We may as well start off on a good note here. Get that disclaimer on the screen. We'll cover lots tonight. Adam Buss, our wealth and estate planning specialist, he's going to go over all the 2023 concepts, RSPs, TFSAs, what's new for 2023, how does it impact the government benefits, what are the tax tips and strategies we need to know, all of that. We are going to get into it tonight. I wanted to put the disclaimer on first. We have to. That's kind of the way it has to work here with our compliance team. A reminder, though, throughout the evening, if you have questions, you want to participate, we welcome that. Whether you're on Facebook or you're on YouTube, simply type it into the comment section. We can see those comments, and we'll make sure that Adam addresses the questions throughout the evening. Let's start, Kevin, with a quick introduction of the firm involved.
Yeah, exactly. That's Clinton Orr. I'm Kevin Becker. We are Becker Orr Wealth Management, and we are members of Canaccord Genuity or CG Wealth Management. We are the largest independent brokerage firm in Canada. We manage roughly $100 billion in assets, and we've been around for roughly 70 plus years. So we've got a long track record going forward. We have offices in Canada, we have offices in the UK and Europe and Australia. We even have some offices in the United States, and this is where the bulk of our investments are. We're also a member of what's known as the CIPF, or the Canadian Investors Protection Fund. This is the insurance scenario to protect your assets going forward. It's the same one that all the major bank firms use, and it also gives you peace of mind going forward that your investments are protected.
Absolutely. And for those just tuning in, Kevin and I are doing a quick introduction. Then we'll bring Adam on to go through all the financial planning and tax tips that'll be applicable for 2023. Continuing the introduction, you can see all of our smiling faces there. And I know we do this every time, but it's important. So we want to do a review. Our promise to each and every client as a team is commitment, clarity, and confidence. For us, commitment, that's all about communication. You need to hear from us. Things change in your life. They change in the financial world. We need to make sure those lines of communication are open. If we do our job there, should lead to clarity. Clarity in the goals, the objectives, full transparency when it comes to rates of return, fees. We want all the cards on the table. High level of commitment, high level of clarity. The end result, confidence. Confidence in our team. And most importantly, some peace of mind and confidence with your financial plan. I see a few more folks have logged in, which is fantastic. For the new folks logging in, if you have a question, simply type it into the comment section. We can see those comments. We'll make sure you get an answer to your question throughout the event. Finishing the introduction here, Kevin, I talked about the financial plan. It's a quirky title.
You did.
Financial architecture, but it's part of our process. How do we build a financial plan? We use the financial architecture. The idea is if you and I were to build a new house, we can't just zoom in on one part. We can't just pick the big screen TV and call it a day. There's more that goes into it. Same thing in the financial world. That financial plan starts in the foundation, which is going to be your estate, your insurance needs. Once that is solid, you can worry about the frame. That's where you talk tax planning, retirement planning. We'll spend lots of time there this evening going through tax and retirement tips. Once the frame is finalized, those decisions will guide what happens with the interior, which are the investment decisions. With that in mind, Kevin, I think we should hand things over here to Adam Buss.
Yeah, just as we bring in our wealth and estate planning specialist in Adam, we are going to start off by mentioning a few important upcoming deadline dates, is what he'll touch on first. We'll go over some RSPs, some TFSAs, some meltdown strategies that we've got for your RIFs or your RSPs going forward. And finally, we'll touch base on what's new for 2023, which is going to be the most important part, I think, for a lot of you going forward. So without any further ado, Adam has been brought in. And Adam, let's give you the floor and see what we have to offer today for financial planning and tax tips for 2023.
Excellent. You guys can hear me fine?
We can.
Perfect. So as Clinton and Kevin both mentioned, if there are questions throughout, by all means, feel free to submit them, whether you're on YouTube or Facebook and watching this live. Again, by all means, submit your questions. We'll do our best to address them as we go on. So again, my name is Adam Buss. I am the Wealth and Estate Planning Specialist here. Works as part of Clinton and Kevin's team at the Becker Orr Wealth Management. I do the financial planning for the client. So this is a little bit about me here. So my background, I've been in the industry. This is actually my 20th year in the financial services industry, which officially makes me sound old when I say that out loud. So what do we want to do when we do comprehensive financial planning? Well, we need to prioritize your goals. My job is to try to save you some money, focus on the big picture, help organize, and most of all, we want to give you peace of mind so that you can worry less about money, both now and hopefully in retirement. This is a key part of our servicing as Clinton and Kevin were both going through the financial architecture. This certainly ties to that. We love seeing our clients have financial plans in place. It's part of our service. There is no one size fits all, so I will cover a lot of general information here today, but certainly, it comes down to what is the right plan when it comes to your financial situation. So a little bit more, I'm sure some of you have seen this slide already, but it just goes through how we want to have all the different moving pieces work together to come up with the right solutions for you as the client. So the client comes first as part of all of our decisions and recommendations to make sure that we have the right items in place. All right. So when we're going to cover some financial planning and tax tips today, some general information. So I'm not an accountant. I'm not a lawyer. Certainly not here to give you individualized tax advice for your particular situation. Certainly, we want to coordinate with your accountant when it comes to some of these recommendations as time goes on. If you do have questions about your particular set of circumstances, by all means, reach out to Clinton and Kevin, and they'd be happy to set up a time to chat. So it is RSP season. So as you're probably well aware at this point in time, so February of the year, certainly a good time to look at some of these deadlines. So RSP contribution deadline for the 2022 tax year is March 1st of this year. So that is just a hair over a week away, March 1st. It is sorry, it's just under a week away. My goodness, I'm losing track of time. RESP contribution deadline is December 31st of this year. So it does not follow the tax year. It is following the calendar year. Depends if you have makeup contribution room for your beneficiaries. We'll certainly cover that on a slide coming up. TFSA contributions, as of January 1st, you get some new contribution room. Is there a deadline to contribute? No. Anytime is the contribution period, but why wait? Why not get that money sheltered inside of there and get in any growth or income generated tax-free moving forward? Personal tax filing, so to keep CRA happy, is May 1st of 2023. So May 1st this year. It is in May, as normally it would be April, but April 30th is a Sunday, so therefore it moves to the next business day. Self-employed tax filing deadline is a little bit later, June 15th. And then, of course, tax bill is due by May 1st. So whether you've actually filed your taxes or if you're self-employed and you haven't filed your taxes, tax bill is still due as of May 1st as of 2023. So make sure you chat with your accountant or tax provider and get that in order. So this, again, is a slide that I probably go through every time, but it does form an important foundation of everything that we look at. So it's a matter of trying to make your overall picture tax efficient. So Manitoba tax rates, as an example, obviously depends on which province you happen to be located in, but it's a tiered tax system. So how the tax brackets work, I'll pick one as an example. So let's say, midway down the list, it's 53,360 to 79,625. That means for every dollar above 79,625, you're taxed at the next highest tax bracket. However, any dollars earned within that tax bracket is taxed at the 33.25% for any regular income, which is interest or employment income, RSP income, anything along those lines is taxed at that bracket. So we always want to look at how can we use these tax brackets to your advantage when it comes to both putting money aside into RSPs and also when we want to look at doing the drawdowns as time goes on. How can we make these brackets work to your advantage and try to keep you in the driver's seat when it comes to that? Contribution limits. So for the 2022 tax year, your RSP contribution limit is $29,210 as the maximum. But of course, it goes and is calculated based on 18% of your prior year's earned income to that maximum. We have some projected amounts there for 2023, 24, and then thereafter in 2025. But again, it does depend on what your actual contribution room is. Where can you find this RSP contribution room? First and foremost, you should check your notice of assessment that you get in the mail from CRA or that gets posted online. If you can log into the My CRA account, you can certainly check your RSP contribution room there. So both the current years of new room that was generated, as well as any past unused contribution room. Certainly very valuable to know because the over contribution penalties are not exactly fun and something that we'd try to avoid at all costs. TFSA contribution room. I'm sure you've heard the exciting news. You've listened to one of our past webinars. 2023 room is $6,500 this year. It went up from $6,000, and now your accumulated limit is $88,000 for your lifetime. So if you've met all the age requirements throughout the time period and you've never contributed to a TFSA, you have $88,000 of room that you can put in. Plus, you can also put in any amounts that were previously withdrawn in different years. But we can cover that a little bit later on as well. So again, when we look at how much RSP room is generated, it's 18% of prior year's earned income. So as an example, let's say a client has $100,000 of salary that they reported. That means, for simple math, $18,000 is their RSP contribution room. So if they've always maxed out their RSPs every single year, that would, in theory, be their only contribution room available. Doesn't matter if the maximum says $29,210, as it depends on what is your particular room or the maximum if you have a higher income level. But how does that change if you get dividend income, investment income, pension income? What is all going towards calculating that RSP contribution room? Well, not everything counts. So if your income is, maybe you're self-employed, maybe you're getting paid in dividends from your corporation. Well, that dividend income is not generating new RSP contribution room for you, along with investment income as well. So certainly, if you're not sure, ask your advisor, chat with your accountant, and again, most importantly, check your notice of assessment. So what other factors can impact your eligible RSP room? So do you have a defined benefit pension plan? As an example, let's say you work for the Manitoba government, the federal government, you probably have a defined benefit pension plan. A lot of the time that is eating up most of your RSP contribution room on an annual basis. You may still have a little bit over and above that, but for the most part, those pensions tend to eat up a lot of your RSP contribution room, thus making it where you can't double dip and both get a nice healthy pension down the road and also maximize the amount going to the RSPs on an annual basis. You also want to consider, does your employer have a matching RSP or DCPP plan? Because we love acronyms in this industry. That would be Defined Contribution Pension Plan for anybody keeping pace with what I'm talking about. So certainly want to factor that in. So let's say you're putting in 5% of your income every year into the matching program. The company's putting funds in. Well, those amounts are also going into a registered plan, which means it is coming off of your RSP contribution room. So certainly want to be aware of that so that you prevent any over contributions. Again, hit this home all the time is check your notice of assessment, check your NOA to make sure that you know what your unused room is. What happens if I over contribute? Well, I did mention this on the prior slide. There is a slight buffer of about $2,000 of over contribution that doesn't necessarily result in a penalty charge. But again, that's more so on a calculation error than something you typically focus on, as even though you over contribute, you haven't actually deducted it, so you have still paid tax on that money. So if you've over contributed over time and you have an undeducted balance, That's money that has had taxes paid on it that's also still in an RSP. So you'd also get tax when it comes out if it never gets deducted. So again, certainly things that you want to chat with your tax professional about and figure out how to use that. I see Kevin's joined me here.
Yeah, we have had a question that's come along. Now, we may be skipping ahead a little bit early, but a watcher wants to know whether or not your TFSA room is also shown on your notice of assessment, or where would I find out how much TFSA contribution room I have left?
So the TFSA contribution room is posted through your My CRA portal. So you can go on there, just like where you'd find your RSP contribution room. It would also show you your unused TFSA room. Keep in mind that it's not always 100% up to date. So if you checked it right now, it would not factor in anything that necessarily happened in 2022 or any contributions that you've made so far in 2023. I find that it's usually around July of every year. It kind of catches up on all the information that was reported to CRA from the prior year. So certainly double check it, double check your records, and just to make sure, again, that you don't over contribute to that.
That's great. Thanks a lot.
All right. Good question. Keep them coming. I think I was done on that one. RSP contributions. So what are the benefits? So RSP contributions are obviously tax deductible. That is the whole point and the whole fun of using an RSP is getting the tax deduction. So it is $1 for a dollar deduction. So if you give $1 to your RSP, it is $1 less of income that you pay tax on. The whole point is to reduce your taxable income, ideally to a lower tax bracket than you were otherwise in. It is a tax deferral. This is not some magical program that is going to allow us to never pay taxes on these funds typically. It is really deferring the tax out to a later year. And hopefully, if all goes well and you've used the program properly, you will draw it out in a lower tax bracket than you're in today when you put the funds in. So again, trying to lower taxes, give some income splitting ability in retirement years as well. You can utilize a spousal RSP plan as a proactive way of doing income splitting. That probably applies more if people are retiring, I would say pre-age 65. That's certainly what it comes in. But otherwise, I wouldn't see a harm in having it. Again, that's one of those things that we want to look at what is right for your particular situation. And you can contribute all the way before the end of the year that you turn 71 to your RSP. If you have a younger spouse and you still have RSP contribution room, you can contribute to a spousal plan for them even after you turn 71. But again, these are things that you should discuss with your advisor to see if it even bothers making sense. I do have retired clients that sometimes ask, should I contribute to an RSP? And sometimes that's just a misconception as to how the program works. And sometimes it does make sense from a tax perspective. So we do want to keep in mind the 3-year attribution room on attribution rules on spousal RSPs. So if you contribute within a 3-year time period that you do the withdrawal would be attributed back to the spouse that put the funds in, i.e. kind of avoiding the actual benefits of doing the spousal RSP contribution, as the funds would then be taxed the contributor. There's also recently some articles posted on RSPs that it's just a waste of time and money because it's just a big tax deferral. But again, that is a real contrarian view that you're only looking at the one side of it. And we want to find what is the program that makes the most sense for achieving your savings goals. So making retirement on track, saving money on tax, and using the right program between RSP and TFSA. So let's do a quick example when we look at RSP contributions. So a client has an earned income of $80,000. RSP contribution room based on a previous NOA is $14,400. So based on the marginal tax bracket system, when looking at Manitoba, the first $5,584 of RSP contribution saves this individual 37.9%, which is the tax savings of ballpark $2,100 and change. The next $8,800 would save 33.25% because they've dropped to a different tax bracket. So They get more money back technically on that portion, but as a percentage basis, they don't get as much. So when we look at this, we want to look at, is there a lot of value to dropping that down below that certain tax bracket? Are they going to take the money out at a lower tax bracket in retirement? And does it make optimal sense? Of course, yes, we always want to put money aside to make sure that the retirement goals are on track first and foremost. So this would be just over about a $5,000 tax savings potential refund on a $14,000 RSP contribution for this individual. So what would you do with a tax refund? Invest it, maybe throw it in your TFSA if you have room, maybe go on a vacation. Is it considered found money for you that you can just go and enjoy at that point in time? Again, discuss it with your advisor to see what makes the most sense. So I'd say it's probably one of the most popular questions that we get asked. I'm sure Clinton and Kevin would agree, especially this time of year, RSP season. Should I contribute my money to an RSP or a TFSA? Ideally, the answer is always both. If you have the extra cash, then why not try to maximize both accounts? You can use your RSP tax refund to put money inside your TFSA. It is ideal if you can have a balance of both tax-free money and taxable funds to draw from in retirement. It's nice that you have the option, or if you have some large expenses, you can take some funds out of the TFSA in retirement without impacting your tax bracket. If you are going to make TFSA as a savings priority for your retirement, remember that those funds are earmarked for your retirement if that is your goal, not spent on an annual vacation or that fancy new TV you see at Costco. Again, just remember what those funds are intended for. And then we often use tax bracket as a bit of a guide to see if it makes sense. So TFSA tends to be a bit more of a priority if you're under around $50,000 of taxable income, and over $50,000 of taxable income, an RSP might be more priority for you. But again, as my favorite answer when it comes to being a financial planner is, it depends. It really depends as to your situation and what happens to be right for you. When it comes to this, especially on the TFSA side, certainly use caution if you are a US citizen, even though you may live in Canada, as those are not tax-free when it comes to the United States. So again, different factors that you want to make sure that your planner or advisor are aware of. So we'll recap some of the basics here of the TFSAs. So it's an account that's been around now for a couple of years, since 2009. Back then, it didn't sound like anything overly exciting, but at this point in time, we've built up $88,000 of TFSA contribution room. And when we project this forward in a financial plan and taking advantage of this throughout somebody's lifetime, the numbers can get really, really large as to how much you can shelter inside this account just by doing that $6,500 on an annual basis. So it certainly does add up. Obviously, a key differentiator is the contributions are not tax deductible. So unlike the funds that we just talked about putting aside into the RSP, where you get a tax refund or tax credit against the amount that was owing, this is not tax deductible. Just like RSP contributions, there are over contribution penalties. So we want to avoid those as best as we can. You have the same investment options inside an RSP and inside of a TFSA. So take advantage of them. It is not just a savings account. You're not stuck just having to have it at your local bank or crediting in an account generating nothing percent of interest. You do have more exciting options that are available to you. So again, certainly explore those. Non-residents they can hold the TFSA, but can no longer contribute, or they will be penalized. So let's say you decide you want to relocate somewhere warm for your retirement. Well, whatever's inside your TFSA can remain there. You just don't generate new contribution room moving forward. And again, certainly if something unique like this comes up, discuss it with your tax professional and your advisor. Continuing, withdrawals. So a withdrawal from an RSP is taxable income when you take it out. Any withdrawals coming out of your TFSA are considered tax-free. So there's no tax bill that results from doing it. The full amount that you withdraw from your TFSA can be put back the following year. So if 2022 I took $10,000 out of my TFSA, I get that contribution room back as of January 1st this year, plus the $6,500 of new room that was generated. The income, of course, that is generated within the account is tax-free in Canada. Again, just have a note here, it is not tax-free in the United States, and certain income types may have a withholding tax if it's a US holding as well. Benefits, obviously shelter from income from tax, allows you to put more money away on top of RSP contributions, and you can use this money for anything, and the income is never taxable in Canada. Clinton has joined me.
We saw a few more questions come in. Please continue to comment. We appreciate the participation. One that came in had to do with the number of TFSAs. Can you have more than one TFSA, Adam?
You can have multiple TFSAs if you want to, but if your TFSA is at Canaccord with Clinton and Kevin, I'm not sure why you would need multiple TFSAs. Yes, they did pay me to say that. But it can get confusing. So I'm not just saying this because, we love having all of a client's business, but you want to be aware that you're not contributing that same amount as your limit at every single financial institution, because that's where we are not talking to each other. Canaccord is not talking to bank ABC and telling each other that you've contributed to your TFSA. So it can lead to over contribution penalties potentially. So it's just something to be aware of.
Yeah, so the contribution limit applies regardless. You have one TFSA, you have 17 TFSAs. The amount of money you can put in total is the same.
Yeah, absolutely.
Another TFSA question came in. Is there a mechanism to transfer the TFSA contribution made through holder number 1, say a credit union, to holder number 2, say Canaccord Genuity? So you got a TFSA at one area. Can you transfer it to a TFSA at another firm?
Yes, you can absolutely, just like you can for RSPs. If you are, not happy at financial institution A, you can certainly transfer that funds in. I don't want to say in kind, but as they are inside that tax shelter, the TFSA or RSP, and that just moves over to the new financial institution and still retaining its status inside the TFSA. So that is absolutely possible. That is merely some paperwork that I do not have to do. That would be a Clinton or a Kevin problem, but yes, it is certainly possible.
And you can move it from one to the other and doesn't impact your TFSA room. So those are good questions. Yep. Continue to type them in the comments section and we'll tackle them as we go.
Perfect. All right. Somehow clicked off my screen and it's lost my mouse. All right, there we go. So income splitting is certainly another factor that we want to look at when it comes to doing financial planning. So taking a proactive approach as it comes to anything for retirement is looking at where is the split of assets. Do both people in the couple have RSPs? Do they have even amounts for RSPs? Does one have a pension plan, the other one doesn't? We want to look at what are all the different income sources and how can we optimize that as a couple. So certain types of income do qualify for income splitting. So pension income from a defined benefit pension plan, that qualifies even before the age of 65. But if you retire before the age of 65, any money that you want to take out of a RIF account, as an example, cannot be split as income until after age 65. So these are things that we want to consider when it comes to, are we trying to equalize RSP assets between both people and the couple? Does it make sense to convert the RSP to a RIF? All of those things. Okay, so again, certainly things we want to look at, and we do need to convert RSPs into a RIF in order for that income to potentially qualify for income splitting. Meltdown strategy. This is not because somebody's having a bad day and is melting down. This is how do we draw down the assets in retirement to make it as tax efficient as possible and keep more money in your pocket and ideally less in the government's pocket. So what order should you draw down or access your retirement nest egg? So perhaps you have a couple different pots of money. You have maybe a corporate account, you have non-registered savings, you have TFSA, you have RSP, maybe you have a LIRA. How do all those different moving pieces tie together to create that cash flow? And in what order does it make sense to draw them down? Okay. Should you convert your RSP to a RIF prior to the age of 71? Again, a very common conversation that we have is by 71 is when you have to do it. However, if you've retired at 60, why not convert the RSP to a RIF? If we're going to start drawing income from it anyways, that likely makes sense as a strategy. Should you take your RSP first before funds from a corporation? Again, if you happen to have a corporation, that is certainly a decision we want to look at. And when it comes to building saving strategies, what tax bracket are you in today? How might that change over your career and also throughout retirement? And can you have too much money in an RSP? That very well can happen. How can we optimize those accounts for you? So again, part of doing all of this is building a financial plan, mapping out your drawdowns, and figuring out what makes the most sense, both to meet your cash flow needs and also to maximize your long-term tax savings. Continuing on the meltdown strategy. So another example. So let's say your taxable income for the year is $71,000 and your annual income will probably be consistent year over year throughout retirement time. So does it make sense to actually draw some extra cash out of your RSP? Well, if we go back to the old Manitoba tax brackets, as we did earlier, the tax bracket caps at about 79,625, and you're paying that 33.25% before you jump to the next higher tax bracket. So I always say, if you can control what level of tax you're going to pay, why not take advantage of that fact and take out a little bit extra income from the RSP or the RIF account? So that means this individual could take out $8,625 of extra income out of the RSP and then use that cash on an after-tax basis. Maybe they don't need it for their cash flow. Maybe it's just going into a non-registered account or TFSA, all those different options. And then if you're married or common law, similar tax situation, well, that you can just double that number. So that means they can take out 17,000 from the RSPs. And again, controlling what level of tax they pay on that. Versus if we just leave it in there and one person passes away, that might lead to that individual being forced into a higher tax bracket or maybe 50% tax on the estate side of things. Again, it's just taking a bit of a proactive approach. So they draw this out. Again, what do you do with the funds? Non-registered account, TFSA, tax exempt whole life insurance, great place to park some money and get some tax exempt growth as well. What happens if you decide to defer the extra withdrawals for a few more years? Again, I already elaborated on this. One person may pass away, you lose the ability to income split. They're going to be pushed likely into a higher tax bracket, a state tax situation. Again, all kinds of different situations that could arise. For most people, wouldn't you rather be in control of how much taxes you will pay when you're withdrawing the funds versus being forced to take it out and pay a much higher rate? RIF account, Registered Retirement Income Fund. So what is a RIF? Well, it's just the account that you start the drawdowns out of. So RSP is the deposit product and a RIF is the income or withdrawal product. So that's all it is. If you want to simplify it to that degree, that's what it is. It's just basically the account that you're starting to take money out of. So all of your RSPs at maturity get converted to a RIF. And then you have to start taking a minimum percentage out on an annual basis. So I do have a chart here. You'll see that the percentage that you have to take out on an annual basis increases as you do get older. As you've had all this time that the money's been tax deferred, you need to start taking some money out and slowly paying some tax on it. You do not have to take out all of the RSPs at 71. You just have to convert them all to a RIF account. And then the next year is when your minimum payment starts. So as an example on the chart, at age 71, your minimum payment is 5.28% of the balance. So if you had $100,000 in the RIF account as of January 1st, your minimum payment is $5,280 for that year. Okay, that is the only amount that you are forced to take out on an annual basis, but for most clients, it typically makes sense to take out more than that. What investment options do I have for a RIF? It's the exact same as an RSP. So again, chat with your advisor, your risk tolerance. It's all the investments generally that you have in the RSP are just changing the acronym on the account to a RIF. Otherwise, nothing else changes. What other options exist? You also have the option to convert your RSPs into an annuity, which is just creating a pension-like income stream for the rest of your lifetime. Kevin.
Yeah, one of our viewers wants to know, they've heard about a pension tax credit that they can get depending on drawing out money along these lines. Can you explain that in a little more depth?
I would love to explain the pension tax credit. So again, I'm not an accountant, but the gist of it is typically after age 65, the first $2,000 of eligible pension income is, I don't want to say tax-free because it's not entirely tax-free. You get a tax credit, a federal tax credit on the first $2,000 of income. So the tax credit is worth 15% of the first $2,000 of income. So it's not entirely tax-free, as if you happen to be in a higher tax bracket, you are going to be paying more than the 15% anyways, along with once you add on, Manitoba or whatever province you happen to be located in. So it's certainly something to take advantage of if it makes sense for you, but I would find it a misconception saying it's entirely tax-free.
Well, that's perfect. That answers the question. Thank you.
Excellent. Again, keep the questions coming. If there's anything else, type it in the window. Clinton, Kevin will do the best to either answer it or pass them my way. And I see Clinton's already going to cut me off before I get to my next slide. So
they're coming in fast and furious now, so we got to answer as many questions as we can. If you start a RIF, I'll read it out for you here, Adam. If you start a RIF, as I did at 61, and decide to go back to work at 63, do I still need to take a minimum, in this case, the minimum of 3.7% out of the RIF, even if you don't necessarily need the money? So you started the RIF, you went back to work, do you still have that minimum kick in?
The short answer is yes. So you would have to take that income. So if you have a balance inside the RIF as of January 1st of the calendar year, that is when your minimum is generated. You don't have to take out anything over and above that. So if you know the prior year that you're going to return back to work the next year, ideally chat with your advisor about converting your RIF back into an RSP. Again, paperwork, but it should be possible to go ahead and accomplish that.
Yeah, so anytime prior to 71, you can flip-flop RSP, RIF, and RIF back to RSP. It's only after
or
71
if
where
you're
it's
really not sure as
mandatory.
to what your income situation is going to look like moving forward, you don't have to do a full conversion. You could convert part of your RSP to a RIF. It's not necessarily an all or nothing. Again, before age 71, you get to decide as to how that works versus having to convert it all.
Perfect. Thanks, Adam.
Okay. Moving on from the our RSPs and RIFs is talking about the RESPs. Maybe not retirement focused, but again, this is financial planning and overall tax tips. So just a reminder, registered education savings plan, great way to get some free money from the government on your contributions. Eligible contribution room is $50,000. You're allowed to make up for past unused contribution room to a maximum of $5,000 per year to get the grant money. Again, a reminder, the grant money is 20% of your contributions. So if you put $5,000 in, had eligible room, that would be $1,000 of grant money that would get thrown in from the government towards your child or grandchild's education. If you have a beneficiary that is turning 17 this calendar year, This is the last year that you can contribute for them and get any grant money. Any contributions for that individual after this year would not get any grant money. If you have a beneficiary turning 15 this calendar year and you have not previously met the minimum funding levels, which I'm going to call a relatively low bar to achieve, then you may not get grant money when they turn 16 and 17. So again, chat with your advisor if there's any concerns that you've not met any minimum funding levels. I also encourage people to review their asset allocation as the beneficiaries do get older. Perhaps when they were, just born and you went with a fairly aggressive portfolio, but now they're nearing the age that they may start needing to draw down on these funds for education. You may want to look at the overall risk tolerance of that portfolio as the time horizon has changed. So again, chat with your advisor on that one. All right, exciting new account coming out this year. So tax-free home savings account. So we've ignored the T and just call it an FHSA at this point in time because we don't have enough acronyms to memorize for everybody. This is new as of April 1st of 2023. It was announced last year. The details are slowly rolling out, so it's not available in the books for anybody quite yet, but it is still forthcoming on April 1st. It will allow somebody to save up to $40,000 tax-free to purchase their first qualifying home. There is a contribution limit on an annual basis of $8,000 a year. You can carry this forward once you've opened the account. So if I do not take advantage of opening the account this year and I open one next year, I only get next year's contribution room. But if I open an account this year and don't put anything in, well, next year I can have $16,000 of contribution room. Just like an RSP, this is tax deductible contribution. And unlike an RSP withdrawal or a home buyer's plan withdrawal, you don't have to repay it, and there's no taxes charged when you withdraw the money down the road for a qualifying home purchase. It does not impact your RSP contribution room. So if your notice of assessment says you have $10,000 of RSP contribution room, you can still do that full $10,000, plus you can put the $8,000 into this account. So another great way to get some additional tax deductions over and above your RSP contribution room. Unlike the home buyer's plan, so just a quick refresher, that is taking money out of your RSP towards a qualifying first-time home buyer's purchase. In that plan, you had to repay those funds back to your RSP over a 15-year time period. This account does not have a requirement to repay the funds. Once you take it out towards a qualifying purchase, you don't have to stress about putting it back. You can also use both the home buyer's plan withdrawal plus the the tax-free home savings account. That means you could do up to $75,000 towards a qualifying purchase. That is a nice, healthy down payment that you can put towards your first house. Kevin, you have some questions here?
Yeah, now I know that this is a fairly new concept that's going on, and there's going to be tweaks going forward, even before the April 1st date when they're supposed to be starting everything along those lines. But the question that's come across is, can I use the proceeds from the tax-free home savings account to buy a home from a relative at a significantly discounted price to the market value?
Well, that's an interesting question. I would assume so. It comes down to, I would imagine, similar to the first-time home buyers or the home buyers plan withdrawal. It comes down to the qualifying transaction that you are buying it as your first qualifying home. So as long as you meet that criteria, that part shouldn't matter. Having said that, I would say the mortgage, whoever's approving the mortgage or your mortgage broker may want to look at that as that has to be written certain ways or certain appraisals done. But otherwise, as long as the qualifying home is your first home, you meet the criteria, I don't think they would care as to who you're buying it from.
That sounds good. That answers the
in
question.
my
Perfect.
opinion. But again, once all the forms come out, if it's anything like the home buyer's plan, there's a lovely little one-page checklist. You go through that and it tells you whether or not you're qualified.
Yeah, basically we have to get through the minutia.
Yeah, that's right. Yeah. All right. I take it that was the only question from Kevin as he disappears on me. All right, so moving on. So government benefits as of 2023. Forgive me if any of this is small in your screen. It's a lot of information. So just going through Canada Pension Plan, Quebec Pension Plan, Old Age Security, Guaranteed Income Supplement, allowances. What are the new limits? So these do go up every year with inflation changes. So right now, if you qualify for the maximum CPP at age 65, it would be just over $1,300 a month. Old age security at 65, $687 and change per month, and so on with the guaranteed income and the allowances. The OAS and CPP are taxable. So again, these are different income sources that we do want to factor in when building a financial plan. They're adjusted for inflation. Again, certainly want to check out what you're eligible for if you're not already receiving it. You can go online to the My Account portal through CRA or Service Canada, and that's where you can find out as to what you're entitled to, or you can have a super fun entire day spent on the phone trying to call somebody to get the information from them. Government benefits 2023 again. So clawback is one that is often misunderstood. So when it comes to old age security, that is an income tested benefit. And if you make too much money, it will get taken away from you either fully or partially as a OAS recovery tax. So if you make over $86,912 as an individual, so that is, well above $180,000 a year as a couple, then, $172,000 and change as a couple, all the way to about $280,000 a couple, it's not really a problem. You're not going to have to worry about clawback necessarily. Okay. But again, these are things that we do want to factor when we're doing RSP withdrawals and meltdown strategy. We do want to factor in how can we try to keep your old age security intact as possible. Other changes that have come in for 2023, a lot of these things do change with inflation. So capital gains exemption for qualified small business corporation shares has increased to $971,190. If you know what I'm talking about, then it probably applies to you. And if you don't know what I'm talking about, then it might not apply to you. Yearly maximal pensionable earnings. This is the amount that is used to determine at what income point do you pay Canada Pension Plan premiums at. So any income earned above this level no longer has CPP premiums charged to it. Income below this level would have CPP charged to it as an employee, as an example. Contribution rates also went up, so it's 5.95% of your income up to the YMPE. Or if you're self-employed, guess what? You get to pay both the employer and employee sides of this benefit at 11.9%. So again, changes that have come up for 2023. Sorry, Clinton, do you want to interrupt me before I move on?
I do quickly here.
Okay.
This is actually going back a little bit, but it's certainly a subject matter you touched on. It is the Education Savings Plan, the RESP, and the question has to do with dual citizens, U.S. and Canadian dual citizens. The RESP is a little background here. If you are a U.S. citizen, the RESP is not very helpful because unfortunately it's not recognized in the tax treaty, which means you don't get all the tax benefits that you would if you were solely a Canadian citizen. The question was, is there another plan that a dual citizen could use for education savings?
I'm going to answer it's complicated, and it depends as to if you're talking about is the dual citizen the beneficiary or the parent, and where do they live, and I'm going to say chat with your advisor. But as for education savings specifically, there are no other plans that I'm aware of in Canada anyways, unless there is something, I'm assuming dual citizen, we're talking about the US, so I don't know if they have anything on their ends specifically, but I would say discuss your situation, and it may make a difference as to who's the subscriber, who's the beneficiary, and what citizenship applies.
Okay. Thanks for the answer.
Yeah. All right, so I chatted briefly about tax-exempt whole life insurance. I've probably beat this drum a few times in prior webinars. Again, it's a great tax tool that somebody can take advantage of to get some tax-exempt growth down the road. It is also a unique asset class, so it's more fixed income-like type of returns over time. So I did one quick example comparing somebody investing $25,000 into a non-registered type savings account versus into a life insurance product over an 8-year time period, assuming they got a 5% rate of return on the portfolio versus what the insurance could get them. At age 90, the insurance was 26% higher. That means their estate got $108,000 more. And of course, they saved some money on tax along the way and through the estate. The internal rate of return, IRR, was just over 4.5%. That's a tax-free rate of return. You would need closer to 7-8% as an actual GIC rate to get the exact same performance as what this could do. So it is a unique type of asset class and also a way to get some tax-free growth. Again, depends on what your goals are that we're trying to achieve to make sure everything's on track. And everything went dark in the office here, but I still have power. So here we go. And all right, so a couple slides left. So when it comes to doing retirement planning, a big one is, do you know what your standard of living is? Do you know what it takes to maintain your lifestyle? 43% of Canadians know how much they're going to need to maintain their lifestyle in retirement, but a lot of people don't know this. This is a key to achieving your retirement plan success. If we don't know what you need to spend in retirement, it is very hard to plan for. We need to have a good idea as to what amount of money you need to maintain that lifestyle. Do you plan on doing anything different versus what you're doing today? Certainly things that you want to look at, and as thrilling of an exercise it is for most people, is probably like pulling teeth. I strongly encourage people to go through a budget exercise to determine what amount of money you need so that you can live the retirement lifestyle that you want. Okay, there is no hard and fast rule that you're going to need 70% or the same income. It is entirely different for everybody. And again, we want to tie together all the different pieces of the puzzle. So what are all the different income sources that you can have in retirement? How do they all work together to create that income stream for you to maintain that standard of living that you enjoy currently? All right, nearing the end here, a couple quick tips. Have you recently retired? Have you assessed any changes to your cash flow needs? Maybe you're coming up on retirement. You need to chat with your advisor about structuring your cash flow for 2023, seeing if there's any withdrawal changes that you need to make. I often say your first 1 or 2 years of retirement are kind of feeling it out and getting used to the new pace and getting used to how your cash flows are and making changes and pivoting as time goes on. If you are retiring soon, review your health and dental insurance needs in retirement as well. Maybe you're used to having a nice plan through your employer and you won't have that in retirement. You can transition to your own plan, typically within 60 days of leaving your employer's plan without having to go through any medical underwriting. And those are things that we can assist and get you some quotes on through our office as well. If you're traveling somewhere warm this winter, which hopefully you are, given how cold it is here at the very moment, did you know that we also sell travel insurance plans? So we can certainly assist you with that as well. When was the last time that you chatted with your advisor about your pre-authorized investment contributions? Maybe you've had the same pre-authorized contribution for the last 10 years going to your RRSP or TFSA. Maybe your wages have increased since that time period. It might be a good time just to revisit that as well. Some general tips. Again, it's a super exciting topic that people love chatting about is reviewing your estate documentation, your wills, your power of attorney, your healthcare directive, your beneficiary assignments, make sure everything's up to date. Review your life insurance. Do you Has anything changed in your life? Maybe you got this 10 years ago when you were single or had no kids, and now you have kids, a mortgage. Make sure that you have the right level of coverage in place. And of course, when was the last time that your financial plan was updated? Most of the time, every 2 to 4 years is probably a good time frame just to revisit it. Sometimes a little bit longer. Again, depends on the situation. If you're not sure if something's dramatically changed in life, certainly worth revisiting that. To end off my section here is financial planning. We want to increase your well-being. So people believe they are better off by having a financial plan. They can achieve their goals. They're content, which is obviously good. And of course, emotional well-being. So giving you the peace of mind knowing that all of your financial goals are on track. And again, that we can look at it in the most tax-efficient lens possible. And that is it for my section. We will end off with some questions. We'll get Clinton and Kevin back here. I appreciate everybody's time, and thank you again, Clinton and Kevin, for having me.
Thank you for showing up.
Great. Well, I appreciate all the information, Adam. There's lots to go through there. I know there's a period there where the slides got a little blurry. We apologize for that technical issue. However, we are recording the webinar where we will post it to YouTube afterwards. So you can always go back and get any of the information you may have happened to miss. In the meantime, if you have a question, type it into the comment section. We're going to stick around for a little while yet to answer any of those questions. Adam covered a whole variety of topics when it comes to financial planning, government benefits, the new tax home savings account, RESPs, RSPs, TFSAs, any of those topics. If you have a question, put it in the comment section. We'd be happy to help out.
And again, also, if you can't think of one right now, but something comes to you later in the day, as it says on the screen here, please go to chatwithclintonandkevin.com, and we'd be more than happy to answer the question through that way as well. And if we need anything else, we can get Adam involved to deal with those questions in addition to ourselves.
That's a very good point, Kevin. So you can always go to chatwithclintonandkevin.com, part of our website, fill in the form, jot down your question there. Whether it is on this topic or maybe it's something a little more specific to your situation, we can also address those. In fact, that's a great forum to address more specific questions, because then we can engage more in your individual financial plan. Chat with Clinton and Kevin. Oh, tough name to say there, Kevin. Chatwithclintonandkevin.com.
Exactly.
Always a great spot to ask the questions. No more seem to be coming in, so we thank everyone for tuning in. If there are questions that come through afterwards, as always, chat with clintonkevin.com. Otherwise, we intend to put more of these webinars together in the future, and hopefully we'll see all of you then. Have a great night, everybody.
Good night.